So I've had a couple people ask me how I pick what I'm going to do options on, or derivatives, whatever you guys know it as. Okay, and I actually stole this picture offline, but it's a really good illustration of kind of how my mind works and I overlap things. Right. So first, we'll start off with good signals. I'm looking for things with extremely high volatility that's trading over a you not back test, but you look past in the 3 months, 6 months, 1 year, and you find a relative range that you want to trade in. Okay, discipline. I am a seller. My discipline is, well, I have a couple. I would look for a delta that's 0.3 and less. Okay, 0.3 and less. Not 0.4, not 0.5. My delta is less than 0.3, specifically because that because I automate all of my trades. This is just my discipline. I will not. The risk becomes too high once you start getting to like 0.4, 0.45, 0.5. It's risk that I don't believe you should be taking. You don't need to, and your best offense is your greatest defense, right? So if your delta is 0.5, you have a 50-50 chance of being profitable. If that's the case, I'm just going to put it all on, I don't know, pick a color, red or black, right? I don't like playing that game. Okay. I think you lose more often than not playing that game. And if I was going to take that, right, and go, I got a 50-50 chance, I'm just going to buy calls and puts and just straddle every position and just wait for a massive volatility. Otherwise, you get into this like lipokurtosis sort of thing. We don't want that. Price action. I'm looking for things that are, again, if you look back in the charts, you're looking for things that have dropped, depending on which direction, right? So I have alerts set up for 4 to 10% massive drop, and then I'll enter a position as long as it fits in my signals, as long as it fits in my bar, right? I'm looking for highs, lows, as long as if I get to my low or below it, which some of you guys know as RSIs. But if I'm mapping out a chart where because you're playing in the small trend line, you're not trying to go up here or way down here. If it drops below my lower time frame, okay, that's my price action. That's a buy for me. Okay, like a cash secured put, selling a cash secured put is a buy. That is a bullish strategy. Okay, positioning sizing is probably one of the biggest things you need to be. They all work collectively together. Position sizing. Position sizing is important because you have I would say that finance is more technical than physics. For instance, if you were to drop a ball, you're going to have a relative gravitational pull for the ball. Like you know exactly where it's going to go. Whereas if you were to drop a ball on the financial markets, there's so many other things that could change the direction in which that ball is moving, right? So position sizing is super important. For beginning traders, maybe trade 1% of your portfolio, get the understanding, then maybe 3%. Personally, I like to not trade more than 3 to 5% of my portfolio. It's a relative thing, and I'll tell you why. Because especially if you're doing, most of you are going to be doing this in margin, but I'll tell you why. If God forbid you break a discipline or something goes against you, right? Your relative position sizing is going to completely go out of whack. And there's so many nuances to finances that most of you will never understand. Okay, I'll give you an example. Here's a nuanced piece that I don't think anyone's ever talked about on the internet, and you'll only know if you call your broker. Here it is. When you sell an option, you collect a premium. If you're doing this in margin, the premium goes against your it will reduce your margin amount, okay? But how does it affect your buying power, right? So say you have $10,000 in margin and you collect a $100 premium, great. Your margin amount will go down to $9,900, which is the amount you're paying on, right? That's borrowed money. But your buying power might increase, it might decrease, okay? So if you're selling a cash secured put, say for $1,000, you're depending on what level of trading you're at, there's a 200% margin maintenance on that, so it'll reduce your subjective buying power by 2,000. Now, if you're doing a covered call, okay, because you own the underlying security, it won't affect your buying power per se. Well, I guess it will. The premium you get from selling a covered call will actually, say it's $100, will actually increase your buying power by 200 versus having a 200% decline of buying power. That's kind of the difference. But you have to understand this in relative terms, because eventually you might have to close that, right? Say the trade goes against you and you have to either close or roll. Those two variables are going to change subjectively. Like as you get closer and closer to expiration, you also need to take in consideration like theta. Theta being, is time decay if you're buying, but on the selling side, theta works in your favor. And as it's kind of hard to explain, each day that goes by towards expiration, your theta is like a yield curve, right? So you might start at 10%, say you're collecting $100, you might start at 10%, 10 cents one day, 12 cents the next day. The closer you get to expiration, it has an exponential yield curve. But how subjective is that yield curve, right? There's like a relative a market against if you have to buy to close early or if you're going to let that expire. A lot of people, if the trade goes against you because you didn't take good discipline or you didn't take good signals or you didn't take good price action, and that trade goes against you, say it shoots down, right, for whatever reason, because it's finance and we don't have a crystal ball, that you might be significantly in profit, on your premium side, but assuming you get assigned or you need to roll, that variable might, rapidly change. So I think this is a good illustration. Stick to your disciplines, get a good strategy that works. And there's so many ways to skin this cat, until you really narrow down which strategy you want to, and only do one thing at a time. Humans weren't built with the cognitive ability to be in 70 different trades at once. If you want to do that, do 70 trades of the same ticker and understand that industry, that stock, that whatever it is, you understand that fundamentally through and through, and you know exactly, its ratios and its sensitivities to the price. You should know that you don't have to do 70 individual tickers. You can do 70 times and stack them. But understand this diagram, because this is what will come out of it. Either you're going to end up paying or you're going to end up getting paid. Okay, and it's a lot easier. This is why I'm a selling option. This is why I'm a seller of options. It is a lot easier to hit, to get to first base, second base, than to get to home runs. Okay, because if you're a buyer of options, your chances of being profitable are, you have to be right about 70% of the time, and that's a really crappy place to be in.